Hey traders, welcome back to the channel. Whether you're just getting started or looking to brush up on your technical analysis skills, today's video is all about candlestick patterns. These patterns are a must-know for anyone wanting to understand price movements in stocks, crypto, or commodities. So, grab a notebook and let's dive in. First up, let's talk about the basics of a candlestick. Each candlestick on a chart represents a specific period of time. This could be a minute, an hour, or even a full day. A candlestick gives you four key pieces of information: the opening price, the closing price, the highest price, and the lowest price during that time frame. The body of the candlestick represents the open and close, while the thin lines, or wicks, show the high and low prices. Now, let's break down the different types of candlesticks you'll encounter. These patterns help traders like us spot trends and reversals in the market. We're going to start with bullish candlesticks. First up are bullish candlesticks. These indicate that the price closed higher than it opened, meaning buyers were in control. A common pattern is the hammer. It has a small body and a long, lower shadow. This typically appears after a downtrend and signals a potential reversal upward. Then there's the inverted hammer. This one has a long upper shadow and appears at the bottom of a downtrend, indicating a potential bullish reversal. Section break. Title card. Bearish candlesticks. Now, let's flip the script and talk about bearish candlesticks. A bearish candlestick means the price closed lower than it opened. Sellers had the upper hand. One of the most recognizable patterns is the shooting star. It has a small body and a long upper shadow. When this appears after an uptrend, it's a sign that the market may reverse downward. Then we have the hanging man, which has a long lower shadow and signals a potential bearish reversal after an uptrend. Section break. Title card. Doji candlesticks. Signs of indecision. Next, we have the Doji candlesticks. These represent indecision in the market. Neither buyers nor sellers have full control. A neutral doji looks like a simple cross, meaning the open and close prices are nearly the same. The dragonfly doji has a long lower shadow, indicating a potential reversal upward after a downtrend. Conversely, the gravestone doji has a long upper shadow and signals a potential downward reversal after an uptrend. Section break. Title card. Engulfing patterns. Let's move on to engulfing patterns, which are some of the most reliable reversal indicators. A bullish engulfing pattern happens when a large bullish candle completely engulfs the previous bearish candle. This signals a potential upward reversal. And, you guessed it, a bearish engulfing pattern is just the opposite. A large bearish candle engulfs the previous bullish candle, signaling a possible downward reversal. Next up is the spinning top. This candlestick has a small body and long shadows, showing indecision between buyers and sellers. Spinning tops are important because they often appear before a major price movement, but on their own, they don't indicate direction. Now, let's talk about Marubozu candlesticks. These candles have no wicks, just a solid body. A bullish Marubozu opens at the low and closes at the high, signaling strong buying pressure. A bearish Marubozu does the opposite, opening at the high and closing at the low, signaling strong selling pressure. Three candle patterns can also give strong reversal signals. Let's go over a few important ones. The morning star is a bullish reversal pattern. It starts with a bearish candle, followed by a small body, and then a large bullish candle. The opposite is the evening star, signaling a potential reversal downward. Another important pattern is the three white soldiers. Three consecutive bullish candles, signaling a strong upward reversal. On the flip side, we have three black crows. Three consecutive bearish candles, signaling a downward reversal. Finally, we have the harami patterns, which show potential reversals in the market. In a bullish harami, a large bearish candle is followed by a smaller bullish candle, indicating a potential reversal upward. In a bearish harami, a large bullish candle is followed by a smaller bearish candle, signaling a potential reversal downward. So, there you have it, an overview of the most important candlestick patterns to help you analyze price movements and make smarter trades. If you found this video helpful, make sure to give it a thumbs up, subscribe for more trading tips, and hit that notification bell so you don't miss out on future videos. Thanks for watching, and happy trading!